expectations that the market has that, you know, we're going to see 125 basis points of front-loaded cuts over the next 3 or 4 months, I think are grossly exaggerated.
Some of your peers have significantly upped expectations, though, for the second half and going into next year in terms of rate cuts. Sajid, where do you stand at right now on how much more we could likely see?
You know, that is an open question, just given what's going to happen globally. I think you have to ask yourself, are we in, sort of March, April of 2009? In terms of the global economy as to where commodity prices are, or are we in sort of the end of 2010, early 2011 in terms of where commodity prices are? I think if you see a significant easing of monetary conditions globally by what the Fed does or the ECB does, I think that will push up global commodity prices pretty significantly this time around. And I think in that environment, the room for the RBI to act later this year will be limited. So I think it will be very data dependent on what happens to global commodity prices and what happens on the fisc side. I mean, if no steps are taken to curb aggregate demand, as the RBI has repeatedly emphasized, then again, I think they'd be pretty hesitant to keep pushing on the monetary policy lever.
As you said, the currency depreciation has had a detrimental follow-through effect as well for various parts of the economy, Sajid, but the Deputy Governor didn't seem to indicate that there was going to be any direct intervention. Would you expect that to start happening, that the Reserve Bank gets its hands in deeper with what's been happening with the rupee as well?
You know, we've seen the impact of intervention has been quite limited. I mean, the Reserve Bank has spent, I would expect, somewhere close to $20 billion over the last 8 or 9 months. That has not had much efficacy. I think they would be very wary of sustained intervention if this is simply a moderation of capital inflows to finance your current account deficit. I think they'd be far more interventionist if you begin to see capital outflows. So I think they're quite comfortable letting the rupee be a floating exchange rate, which I think is the appropriate policy. That does become your shock absorber to global shocks. But that also has a feedback effect onto inflation. So what you don't want to do is aggressively ease monetary policy when your currency is under pressure.
One final question, Sajid, on the CRR, because there are many who believe that the case for a repo rate signal may not be very high, but maybe they could do something on the liquidity front with a 50 basis point CRR cut. How strong is the case for that?
I think there is a case for that. I think absent a repo cut, it's very likely that you, or likely that you get a CRR cut as sort of the intermediate signal that they want to loosen policy but not go all the way towards a repo cut. So I think that is possible because we do expect there'd be, you know, some intervention going forward in the foreign exchange market that will tighten domestic liquidity, and so a CRR cut at this point, you know, would be useful to balance things out. So I think the likelihood of that does exist.
Thanks, Sajid, for joining in today with your thoughts. JP Morgan on inflation.